Welcome back for another deep dive with us. Today we're going to be tackling a challenge that has probably crossed all of our minds.
Okay.
If we've ever even dipped our toes into the stock market, how to predict these sometimes wild price swings.
Yeah.
It's like trying to guess what a room full of people are thinking all at once.
Isn't it? Yeah, I can certainly feel that way. There's so much noise and emotion involved.
Exactly. That's where chart analysis comes in.
Uh-huh.
And we are diving into how charts can help you in the stock market by William Jiler.
Okay.
A classic guy that suggests we can actually decode these market moods through the visual language of charts.
Charts offer a fascinating window into market psychology, essentially a visual history of this constant tug of war between buyers and sellers.
Now, you've provided us with some key excerpts from this book, and to help us break it all down, we are joined by our market expert.
Great.
I, for one, am so eager to learn how these lines on a graph can actually reveal insights into investor behavior.
It's all about recognizing patterns, understanding trends, and most importantly, learning to read between the lines, so to speak.
Okay, so let's start with the basics. If charts are more than just lines, what story are they really telling us?
Think of a chart as a visual representation of this ongoing battle between supply and demand, fear and greed in the market.
Oh.
It's the collective actions of all buyers and sellers playing out in real time.
So, like a footprint tracker in the wild, learning to recognize the paths and predict where an animal might head next.
That's a great analogy, just as those footprints can reveal patterns in an animal's behavior.
Yeah.
Charts can help us identify recurring patterns in market behavior that suggest where prices might go.
Oh.
Of course, just like any predictive tool, it's not foolproof.
Right. So no guarantees, but we can get clues.
Exactly.
One thing that Jiler really emphasizes is this concept of trends. It seems that stocks tend to move in trends like a snowball gathering momentum. Why is that?
It boils down to human psychology. When a stock is trending upwards, it attracts more buyers who see an opportunity for profit, further pushing the price higher. Conversely, a downward trend breeds fear and uncertainty, leading to more selling and driving the price lower.
It's almost like a self-fulfilling prophecy.
Right.
But the book also mentions that even when a stock breaks a trend,
Yes.
it's often pulled back, almost as if by a magnet. He calls it the pullback effect.
Exactly. Imagine stretching a rubber band. When you let go, it snaps back to its original shape. Similarly, even if a stock breaks a trend line, there's often a tendency for it to be drawn back towards that trend.
So even a break in a trend might not be the end of the story. Jiggler suggests paying close attention to volume, the number of shares traded, to see if a trend break has legs. Why is that?
Volume adds context to price movement. A high volume break suggests conviction, while a low volume break might just be a temporary blip. It's like the difference between a whisper and a shout. The louder the shout, the more attention it commands.
Let's dive into another key concept from the book. Support and resistance levels. I think many of us have experienced that sinking feeling of buying a stake only to watch it fall, wishing we could sell at our purchase price.
Right.
Is that a support level in action?
You've hit the nail on the head. Support is like a floor beneath the falling stock.
Okay.
It's a price level where buying pressure tends to outweigh selling pressure. Preventing further decline. Resistance, on the other hand, is the opposite.
So resistance is like a ceiling that prevents the stock from rising further.
Precisely. It's where selling pressure intensifies, putting the brakes on upward momentum. Think of past trading ranges.
Okay.
Especially those with high volume.
Yeah.
As battlegrounds on a chart.
Okay, so those high volume areas where buyers and sellers previously fought it out can actually become future support or resistance points. But why?
Because they represent points of significant price action. And investor memory, investors tend to remember those levels.
Right.
And their decisions are often influenced by those memories.
It's like those past battles leave a psychological imprint on the chart. The book also mentions a tactic called the 50% rule. What does that mean exactly?
Stocks often retrace half of the ground gained or lost in a swing before resuming their trend.
Okay.
The 50% rule highlights those areas as potential support or resistance zones, giving us possible entry or exit points.
So instead of simply chasing a rising stock or panic selling a falling one,
Right.
this rule suggests looking for opportunities during those retracements.
Exactly. Understanding these levels can help us anticipate potential turning points in a stock's price, giving us a slight edge in navigating those volatile swings.
Now, for the part I've been especially looking forward to, the intriguing shapes and formations that can emerge on these charts.
Yeah.
The book mentions head and shoulders patterns, a classic that I'm sure many of us have heard of.
The head and shoulders is a well-known reversal pattern. Imagine a peak, the head flanked by two lower peaks, the shoulders.
Oh.
It's almost as if the market is getting tired of pushing higher.
Like a giant who's turning away from the market, ready to head in a different direction.
That's a great visual. The head represents peak enthusiasm, but as the shoulders form, it suggests that buying interest is waning. Now here's a key detail to watch. For volume should typically decrease on the right shoulder.
So decreasing volume on that right shoulder confirms that the momentum is fading, adding validity to the pattern. Fascinating. What about those double tops and bottoms?
Yeah.
That sound like they'd be easy to spot.
They can be. They're like the market's version of the hokey pokey double tops look like an M forming on the chart, while double bottoms resemble a W.
Catchy. But what story are those shapes telling us?
They represent two failed attempts to break through a specific price level. Think of it as the stock testing those levels, but ultimately failing to break through.
So it's almost like the stock is saying, I tried to go higher or lower, but I just couldn't break through.
Precisely. And that failure can be a powerful signal that a reversal might be on the horizon.
We also have those line and saucer formations. The names alone conjure up interesting images.
Lines signal periods of consolidation where the stock's price moves sideways within a narrow range, almost like it's taking a breather before making its next move. Often this consolidation is followed by a breakout either upward or downward. Now, saucers.
Hold on, before we get to saucers, I'm curious about the volume during those line patterns. It seems like it would be pretty low, right?
You're right. Volume typically dwindles during these consolidation periods, almost like the market is holding its breath, but then when the breakout occurs, volume surges, signaling a renewed sense of conviction.
So it's like a coiled spring suddenly released. Okay, now tell me about those saucer formations. What are they all about?
Picture a gently rounded bottom forming on the chart. That's your saucer. These formations typically occur after a period of decline. And as the selling pressure eases, the price starts to stabilize, forming that distinctive saucer shape.
So a saucer formation suggests that the decline might be coming to an end, and a potential reversal could be in the cards.
Exactly. It's a sign that the selling pressure is waning and buyers are starting to step in, creating that rounded bottom.
Okay, let's move on to V formations, which sound a bit more dramatic. Like the market's roller coasters.
They certainly can be. V formations are characterized by sharp and sudden reversals, with the price plummeting and then surging back up, or vice versa with remarkable speed.
Sharp drops and sudden rebounds definitely sounds like a roller coaster. But how do we know if a V formation is reliable?
Volume is key here, just as it is with many of these patterns. High volume on the pivot point. That sharp bottom of the V is crucial for confirmation.
So high volume confirms the intensity of the reversal, suggesting a genuine shift in sentiment rather than just a random fluctuation.
Exactly. Now, there's also a variation called the extended V.
Extended V, tell me more.
An extended V includes a platform or consolidation phase after the initial sharp reversal. It's like the V takes a brief pause, catching its breath before continuing its trajectory. This pause can offer a better opportunity for those who missed the initial sharp move to get on board.
Okay, and then there's the measured move, which sounds a bit more predictable, like a planned train journey with a predetermined route. Am I on the right track here?
You're very close. The measured move helps us predict where a stock might meet resistance or support after a pause or correction.
Oh.
It's like a train journey. First leg, a brief stop, then a second leg of equal distance.
So the first leg of the journey sets the direction and momentum. The correction acts as a brief stop.
Right.
And then the second leg resumes the journey with a similar force.
Precisely. It's all about recognizing those patterns and anticipating the potential price targets based on the length of the first leg.
Jiler acknowledges that price charts are just one piece of the puzzle.
Right.
When it comes to market analysis, what other indicators does he suggest considering to gain a more complete picture?
One interesting indicator is the advanced decline line. It tracks the number of stocks advancing versus declining each day, offering insight into the underlying strength of the overall market.
So even if the major market averages are trending upwards, a declining advanced decline line might suggest underlying weakness, like a crack beneath the surface.
That's a great way to put it. It helps us see whether the rally is broad-based, with participation from a wide range of stocks, or if it's being driven by just a few heavy hitters.
Makes sense. Now, another indicator Jiler mentions is Barron's Confidence Index.
Mm-hmm.
This one surprised me because it focuses on the bond market. Are you telling me bond investors offer clues about the stock market too?
Absolutely. The Barron's Confidence Index compares yields on high-grade versus low-grade bonds.
Okay.
This reflects investor confidence in the overall economy.
Okay, but how does that relate to stocks?
The theory is that bond investors, especially those managing large sums, are often ahead of the curve.
Okay.
Their actions in the bond market can foreshadow potential moves in the stock market. Think of it as,
Hold on, before you give me another analogy, I'm curious about this concept of short selling. The book mentions the short interest ratio as an indicator, but how can betting against a stock be a clue for the rest of us?
that's where it gets interesting. A high short interest ratio means many people are betting on a stock to go down.
Right.
But here's the catch. Those short sellers eventually have to buy back the stock to cover their positions.
Ah, I see where this is going. So a high ratio could actually create a surge in buying pressure, pushing the price up.
Exactly. It's a contrarian indicator suggesting a potential for what's called a short squeeze, where short sellers are forced to buy back the stock,
Right.
driving the price higher.
Okay, no more analogies for now. What about this odd lot index I see here? What's so odd about it?
This one tracks the trades of small investors.
Okay.
Those buying or selling odd lots of less than 100 shares the theory behind this indicator, is that small investors tend to be less informed and often make emotional decisions, buying when the market is already high and selling when it's low.
So by tracking their behavior, we can get a sense of where the smart money is not going. It's pretty clever.
It's a contrarian indicator, much like the short interest ratio now. One more indicator to discuss is the 200-day moving average.
Ah, yes. That one I see mentioned all the time. But I'll admit I'm still not entirely sure what to make of it. Help me out.
It's a simple but powerful tool. This long-term average smooths out daily price fluctuations, helping us identify major trends. Think of it as seeing the forest rather than getting distracted by the individual trees.
Okay, I like that. So if the current price is above the 200-day moving average, that's generally considered bullish, indicating an uptrend, while a price below that average suggests a bearish downtrend.
It's a way to filter out the noise and focus on the prevailing direction of the market.
You know, while reading the excerpts you provided, I was struck by how much this book emphasizes understanding the psychology of the market.
Psychology is at the heart of chart analysis. Charts aren't just about lines and patterns. There is a visual representation of the collective hopes, fears, and decisions of millions of investors.
So it's not just about recognizing those patterns, it's about understanding why they form in the first place.
Exactly. Chart patterns reflect the collective behavior of investors. They offer a glimpse into the emotions that drive market movements.
And once we grasp those psychological drivers, we can potentially anticipate market moves by recognizing the patterns of behavior that tend to precede them.
Precisely, however, Jiler cautions against becoming too obsessed with predicting the future. He emphasizes understanding the present and responding accordingly.
So instead of trying to predict every twist and turn, it's more about recognizing the current trend and managing our risk.
Exactly. It's about staying present and adapting to the ever-changing market landscape.
That makes a lot of sense. He also stresses the importance of discipline and patience. Those seem like pretty valuable traits regardless of whether you're a seasoned investor or just starting out.
Absolutely. Discipline helps us stick to our plan and avoid those impulsive emotional decisions that can lead to costly mistakes. Patience allows us to wait for the right opportunities and ride out those inevitable market fluctuations.
It's like that classic saying, time in the market beats timing the market.
Exactly. It's about staying invested for the long term and letting compounding work its magic.
This deep dive has really opened my eyes to the power of chart analysis. I can see how it could be a valuable tool, but from the excerpts, it also seems Jiler is careful to point out that it's not a crystal ball.
Right. No system can predict the future with 100% accuracy. It's important to be realistic about the limitations of chart analysis.
And it seems the book stresses that chart analysis should be used in conjunction with other forms of analysis like fundamental analysis, and we should always consider the broader economic context.
It's about taking a holistic approach to investing, considering multiple perspectives before making any decisions.
Now, something else Jiler highlights is the recurring theme of volume. Why does he keep coming back to that?
Because volume is crucial for validating price movements. Remember the analogy of the whisper versus the shout. A price movement with high volume signals conviction, while a low volume movement might just be a fleeting whisper.
So price tells us what's happening, but volume adds context, telling us how it's happening.
Exactly. It's the combination of the two that paints a clearer picture now if you're wondering how we can apply all of this knowledge in a practical way.
I was just about to ask that, how can we use these patterns and indicators to actually make informed investment decisions?
Well, for instance, we can use chart patterns to identify potential buying or selling opportunities. Let's say we see a breakout from a long base formation, a period where a stock has traded within a tight range for an extended period.
Like that coiled spring we talked about earlier, finally releasing its energy.
Precisely, if that breakout is accompanied by increasing volume, it could signal a good time to buy, on the other hand.
A breakdown from a support level on high volume might be a signal to consider selling.
Exactly. Chart analysis can help us time our entries and exits more effectively.
What about using those support and resistance levels to set price targets or stop-loss orders?
That's a smart strategy. Support levels can act as potential buying zones, while resistance levels can help us identify selling zones. Stop-loss orders can help us limit potential losses if a trade goes against us.
It's all about managing risk and maximizing profit potential.
Right now, beyond individual patterns, Jiler also delves into broader trading tactics and investment strategies in the book.
Give me an example. What kind of strategies are we talking about?
One classic strategy is to buy on weakness, sell on strength. Instead of chasing a stock that's already gone up significantly, you look for opportunities to buy during pullbacks or corrections when the price is closer to a support level.
So you're essentially buying at a discount, hoping to ride the next wave up.
Exactly. And then you might look to sell when the price approaches a resistance level, taking profits before a potential reversal.
That makes sense. It seems like a more disciplined and strategic approach than just reacting emotionally to price swings. But Jiler is also clear that this is all most effective when combined with a solid understanding of the companies you're investing in, right?
Absolutely. Chart analysis is just one piece of the puzzle. It needs to be coupled with fundamental analysis, a thorough understanding of a company's financials, its industry, and the overall economic landscape.
It's like having all the individual pieces of a puzzle, but chart analysis helps us see how they fit together to form a clearer picture.
That's a great analogy. It gives us a framework for understanding market dynamics.
Now, even with all this knowledge, it's important to remember that no system is foolproof. The market can be unpredictable, and there's always an element of risk.
Definitely we need to be realistic about those limitations and always manage our risk accordingly.
One thing that really resonated with me from the excerpts was Jiler's advice to be adaptable and flexible in our approach. He seems to emphasize that the market is constantly evolving.
He's absolutely right. We need to be able to adapt our strategies as the market shifts. Holding on to rigid beliefs or outdated strategies can lead to missed opportunities or worse, significant losses.
And we need to be willing to change our minds if the evidence suggests we're on the wrong track.
Without a doubt, stubbornness can be a costly trait in the stock market.
You know, one thing that keeps coming back to me is the importance of psychology in all of this.
It really is the driving force behind everything we see on those charts.
I'm starting to see that chart patterns are like a language that once we learn to read it, can offer us a glimpse into the collective mind of the market.
Exactly. It's about recognizing the recurring patterns of behavior that drive those price movements.
But as you mentioned earlier, it's not about trying to predict every little detail.
Right. As Jiler points out, it's more important to understand the present and respond accordingly rather than getting lost in trying to predict the future.
So focus on identifying the current trend, managing risk, and being prepared to adapt as the market unfolds.
You've got it.
It sounds like what we're really learning here is how to read the story that charts are telling us about market sentiment.
Exactly. It's about understanding those narratives and using them to inform our decisions.
Now, this has been fascinating, but I know we're only scratching the surface here. There's so much more to this book and to the world of chart analysis.
Absolutely. This is a lifelong pursuit, full of continuous learning and discovery.
What are some of the other key takeaways from the book that you think are important for our listeners to know?
One key takeaway is that while charts can be incredibly valuable, they are most effective when used in conjunction with other forms of analysis, like fundamental analysis, another important point. Jiler emphasizes that chart analysis is not a guaranteed path to riches. It's a tool that can help us improve our odds, but it's not a magic formula.
So no get-rich-quick schemes here. It sounds like what we're really talking about is a way to make more informed decisions by learning to read the language of the market.
That's a great way to put it. It's about gaining an edge by understanding the forces that drive price movements, recognizing those recurring patterns, and learning to manage risk effectively.
And as with any skill, it takes time, practice, and ongoing learning to truly master it. The excerpts you provided mention several real-world trading examples using actual charts from the book. I have to say, seeing those examples really help bring those concepts to life.
Visualizing those patterns in real-world scenarios is crucial for understanding how they play out in actual trading. Jiler provides numerous examples throughout the book, breaking down those formations step by step.
And in those examples, he also stresses the importance of combining chart patterns with other indicators and considering the broader market context. It's really about putting all those pieces together, isn't it?
It's like being a detective gathering clues from various sources to form a more complete picture. Charts provide one set of clues, fundamental analysis provides another, and the overall economic backdrop provides yet another layer of context.
It sounds like what we're ultimately learning here is how to think like the market, to see the world through the eyes of other investors.
That's a great way to frame it. Chart analysis is, in essence, a way to tap into the collective psychology of the market, to understand the forces that shape those buying and selling decisions.
This has been incredibly insightful. I feel like I've gained a whole new perspective on the stock market and a deeper appreciation for the power of chart analysis.
It's been a pleasure sharing these insights with you.
Now, for those listening who are eager to delve deeper into this world, what are some key steps they can take to start putting this knowledge into practice?
First and foremost, I highly recommend diving into the book itself. How Charts Can Help You in the Stock Market is a classic for a reason. It lays out the foundations of chart analysis in a clear and comprehensive way, beyond that there are numerous resources available online.
Before you go on, let me just add that for those who want a quicker overview, we'll be sure to include links to some helpful resources in the show notes.
Great idea. As I was saying, online resources can provide further insights and real-time examples. And of course, practice is essential. Start by observing charts, identifying patterns, and testing your knowledge. There are even simulated trading platforms available where you can practice without risking real money.
It's a great tip for those who want to get their feet wet before diving into live trading.
Absolutely. And remember, patience and discipline are your allies. It's a journey of continuous learning and growth. So don't get discouraged if you don't become a master chartist overnight.
This deep dive has really been a journey of discovery. I'm already looking at charts in a whole new light, and I'm excited to continue exploring this fascinating approach to understanding the market.
It's a journey worth taking.
Well, that brings us to the end of our deep dive into the world of chart analysis. I hope you found it as illuminating as I did.
It's been a pleasure.
And for all of you listening, we encourage you to pick up a copy of How Charts Can Help You in the Stock Market and embark on your own journey of learning and discovery. Who knows, you might just unlock the secrets to reading the mind of the market. Until next time, happy charting.